We talked about it earlier in terms of the increased regulation into the banking sector in particular, capital adequacy ratios, debt to income ratios, these sorts of things. How do you see that potentially flowing through to bank margins? Bank lending margins, I should say.
Yeah, well, the bank lending margins are compressed. In one of my weekly publications, every week I put in 4 graphs for mortgage lending rates, 1 year fixed, 2 year, 3 year and 5 year. And so I just do a basic comparison of the swap rate, let's say for 1 year, the cost to a bank of borrowing money to lend fixed for 1 year versus what's generally the best 1 year fixed rate out there. And so you get a graph going up and down of the margin for the bank. And I work out the average for the past 2 years. Well, for a long time now, the margins have been below average. And those margins for all of the fixed rate lending for the banks, they're still about 0.5% below average. So even if there was no change at all in monetary policy, wholesale interest rates, there's actually still about 0.5% of extra catch-up to do by the banks. And so earlier on, I think I mentioned the 5-year fixed mortgage rates were 2.99. Now you're pushing 5%. Well, there's at least another 0.5% increase to go there before we even sort of talk about where might monetary policy, etc., go. So comment I've made for 2 or 3 months is I think banks will use the fog of confusion surrounding monetary policy inflation to look to rebuild the margins. And when I'm looking across at Australia, where there's just been a selling down of the CBA, Commercial Bank of Australia shares, because their margins have got compressed, and our banking sector is largely owned out of Australia, the bankers are going to be looking to rebuild margins in the near future. Extra upside pressure on lending rates.
Internationally, it's probably a good segue in, is internationally we see the non-bank sector playing a much bigger part in the lending market, whether it be Australia, US, Great Britain. In New Zealand, it seems to be in its infancy. Do you see the non-bank sector taking a bigger part of that market as the banks face into things like capital adequacy ratios and various other things?
Yeah, I think most definitely. It's been, I guess, an interesting period since the GFC, where we've had increasing regulation of the banking sector or the financial sector overall, which means we've gone into the global pandemic shock with New Zealand's financial sector, the institutions, in very, very good shape. I think it's one of the reasons why the impact on our economy hasn't really been all that bad. But now, as we see the debt-to-income ratios being applied there for the banks, the Credit Contracts and Consumer Finance Act. I had to memorise that a few weeks ago when I realised I didn't know what all the C's added up to. Running through the banks and affecting their assessment of applicants' expenses to a detail we've never seen before in New Zealand. People are getting loans turned down, young people, because the bank's saying you're spending $200 a month on coffee. Actually, I think that's conservative. And so that's running through, along with the LVRs, the reduction in low deposit lending. And I think we will naturally see the applicants move across to the non-bank lending sector. So I definitely expect to see growth, not just a sort of cyclical thing. I think it is going to be a bit of a structural lift over the next 5 years in the size of the non-bank lending sector in New Zealand.
Yeah, and that sector looks a lot different to what it did pre-GFC, doesn't it? I mean, our whole financial landscape looks different in terms of we don't have the proliferation of the finance companies and the like, so probably provides a much more robust platform for lending going forward.
Yeah, the world is completely different from what it was pre-GFC. I suppose for the finance companies, the banking sector in New Zealand and their assessment of risk, a lot of that was addressed in the early 1990s after the share market boom from 84 to 87, the share clubs and the banks trying to outbid each other to lend as much money as humanly possible. A lot of changes were made there in the late 80s and the 90s, but it's like the finance companies, the central bank didn't pay any attention. Well, now, of course, the attention has been paid ever since, before the GFC, actually, quite frankly, just a bit late in the piece there. And it's actually been surprising over the past few years that we haven't maybe seen more non-bank lenders grow in New Zealand. I think the growth will come from a shift in the existing business rather than necessarily new players that we've never heard of before entering the New Zealand market and grabbing a lot and producing more activity. But it is a different world in the financial sector now from pre-GFC, and obviously everything's different from 84 to 87.
Yeah, that's right. Yep. Now look, we could actually talk all day here, Tony, because it's there's a lot to talk about and it's pretty interesting. But I suppose as a wrap up, is we if you're summarising 2022, what might that look like?
2022 will involve, I think, the housing market flattening out, talk about brain drain to Australia, There'll be talk about wage price spiral with wages going up. I mean, with inflation is a measure of the change in your cost of living. So the inflation rate is 4.9%. The average household's cost of living has gone up by 4.9%. And if you haven't had a 4.9% wage increase, you are poorer now over this past year. So there'll be increased wages, increased inflation, and of course we're all going to be learning stuff about reopening of the world economy. I have a positive outlook for our economy, but I'll be giving a warning to the business sector generally for some time. You've got to be careful of the growth that you're planning. Just because I say it's a good outlook for the economy, I'm talking about demand from customers generally is going to be strong, but that's not really a problem for most businesses these days. They've got more customers than they can service. Their problem is finding the staff, finding the materials, maybe the premises, the computer experts to redesign the computer system. And my comment to businesses has been, for the environment going forward, focus a bit less on marketing, branding, advertising, more customers, and a lot more on keeping your existing staff. What does it take to keep them? Fish and chips on a Friday, is it? Frankly, for some, it's going to be all. Your supply chains, focus a lot more there on what resources can I command for the next 5 years, and then see what level of output will that actually allow you to sustain going forward. They've just got to reverse sort of things. And if you find somebody who's very good with HR management, human resources, supply chains, pay a premium to get that person on board, because they are becoming more valuable than the marketing executive in this new environment.
Yeah, no, very good. Thank you very much, Tony. We really appreciate it. I'm sure everyone watching this has taken a lot out of it. So thanks again.
Okay, thanks very much for having us. And yep, I certainly hope so. Cheers.
Cheers.